A 158-year-old financial giant, over $600 billion in assets, and in just a matter of days, it collapsed. This is the story of Lehman Brothers, the fall that triggered the biggest financial crisis of the modern era, and the moment that changed the global economy forever. Founded in 1850 as a small family business, Lehman Brothers grew into one of the most powerful investment banks on Wall Street. It survived the Civil War. It survived the Great Depression. It survived world wars and recessions. But in 2008, the storm it faced was different. Because this time, the danger wasn't outside. It was building from within. In the early 2000s, the United States housing market was booming. Banks were giving mortgages to almost anyone, even to people with poor credit histories. These were called subprime mortgages. The risk was obvious, but nobody cared because everyone was making money. Home prices kept rising. Banks packaged these risky loans into complex financial products and sold them to investors around the world. The risk didn't disappear, it spread, and no one truly understood how big the ticking time bomb had become. Lehman Brothers was one of the most aggressive players in this system. They used extreme leverage, borrowing massive amounts of money to amplify their bets. Profits were enormous, but so was the risk. At one point, Lehman was leveraged more than 30-to-1. That meant even a small drop in asset values could wipe out the company. And that's exactly what began to happen. In 2007, cracks started to appear. Housing prices began to fall. Mortgage defaults started rising. The financial products tied to those mortgages started losing value. Investors grew nervous. But Lehman's leadership remained confident. Publicly, they insisted everything was under control. Privately, the balance sheet was deteriorating fast. By mid-2008, the situation had become critical. Losses were mounting. Trust was evaporating. Lehman's stock price was collapsing. The market began asking a dangerous question. Could Lehman Brothers actually fail? And in finance, once confidence disappears, survival becomes almost impossible. September 2008. Lehman was running out of cash. Buyers were approached. Government support was expected. But this time, the U.S. government chose not to intervene. On September 15, 2008, Lehman Brothers filed for bankruptcy. It was the largest bankruptcy in American history. A 158-year-old titan, gone. But this wasn't just the fall of one bank. It was the first domino. Global markets crashed. Stock exchanges plunged. Banks stopped trusting each other. Credit markets froze. The world economy spiraled into what became known as the 2008 global financial crisis. Millions lost their jobs. Homes were foreclosed. Entire economies went into recession. So what really caused the collapse? Greed? Overconfidence? Lack of regulation? The truth is, it was a combination of all three. Lehman believed housing prices would never fall nationwide. They believed markets would stay liquid. They believed they were too important to fail. They were wrong. Lehman Brothers proved a powerful lesson. No institution is too big to collapse. When risk is ignored, when leverage is abused, when confidence replaces caution, even giants fall. Today, Wall Street is still standing. Markets still rise and fall. Banks still take risks. But September 15, 2008 remains a warning etched into financial history. A reminder that unchecked growth can become uncontrollable destruction. This was the fall of Lehman Brothers. And this is Capital Stories, where we explore the rise and collapse of the world's biggest companies. Because behind every empire, there's a story, and sometimes a downfall.